Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Starting the new year with two more familiar names in the stock world for you to consider. Our strategists are here with each of them, Shiraz Mian here with me at the desk, and Dave Boren, who is joining us via Skype from the great beyond. But since you're the boss, since you're the research director, we'll start the new year right.
Sure.
We'll start with you, with J.P. Morgan.
J.P. Morgan, yeah. So it's hardly an unknown pick for anyone, particularly for our audience. And it's more of a sector industry call than a specific stock, even though I really like J.P. Morgan. It's a very well-run company. For the last many years, banks in general, finance in particular, has been this unloved area because of what's happening on the interest rate front, because of how the regulatory environment changed post the last crisis. And there's a fair amount of truth to all of those issues. But I think that has been overdone. I think there's some very quality companies with impressive balance sheets, J.P. Morgan being the best of the lot in that area, with impressive balance sheets, strong cash flows, and even in this tough earnings environment, when interest rates and as a result the net interest margins have been razor thin, they have been able to grow earnings. In fact, in 2019, and we have these guys reporting results next week. JP Morgan is on deck for January 14th.
For Q4.
For Q4, that's right.
Yeah.
For 2019 as a whole, JP Morgan will have a higher earnings growth than the S&P 500 as a whole. The banks industry as a whole will have higher earnings growth pace than the S&P 500. Valuation is reasonable. JP Morgan is currently trading at about 71% of the S&P 500 index based on forward 12-month earnings. At the high end, this has gone as high as 85%. So it's always at a discount, but the discount is much higher than the historical times. It's a cyclical industry. So folks having concern about the duration of the cycle, worries about the economy, perhaps are holding back. But I think for all the reasons that I cited earlier, they're totally worth considering. If someone has a beef against J.P. Morgan because they are the biggest, other good names are there too. Bank of America is very good. I like Citigroup as well. Wells Fargo is still dealing with its issues because of the problems it had a couple of years ago. But even they are on the mend, and that stock is even cheaper than many of the others. So it's more of a sector call for me. And I'm featuring J.P. Morgan as an excellent example of how one could play this industry.
All right. Dave, you're kicking things off in the new year with a military stock, Northrop Grumman.
Yes, sir. So 2019 was a pretty spectacular year for U.S. equities. Low interest rates and generally benign conditions propelled all the major averages up between 25 and 35%. As we enter the new year, however, the only obvious clouds on the horizons are the renewed possibility of armed conflict between Iran and the United States. During the first trading session of 2020, stocks continued the broad rally and then retreated after news that the U.S. had executed a drone strike that took the life of a key Iranian general. Now, of course, it's impossible to know exactly how the situation will play out, but right now it looks like President Trump is showing no signs of backing down in the defense of U.S. interests and the Middle East and the protection of our allies in the region. So not surprisingly, as the financial markets digested the possibilities of extended armed conflict, the stocks that performed best during the sell-offs were defense names who supply the aircraft and other systems for U.S. efforts overseas. And the granddaddy of them all is Northrop Grumman. That's symbol NOC. So as the major indexes lost ground after the drone strike news, Northrop shares added better than 5% on the Friday session in anticipation of increased U.S. defense spending. President Trump had campaigned on a promise to rebuild a depleted military. And in office, he's definitely living up to that promise. He signed into law the 2019 National Defense Authorization Act and commits more than $700 billion annually to defense spending, even during times of peace. And even when other budget considerations remain unresolved, Congress and the president tend to generally have an easy time agreeing on defense spending. Defense technology has been evolving rapidly, specifically to include unmanned aircraft. Northrop Grumman is a clear leader in that field. They developed the world's first autonomous air system that can operate from the deck of an aircraft carrier. And that's the exact kind of technology that the U.S. is likely to use in the event of a protracted engagement in the Middle East to accomplish objectives while doing everything possible to protect American servicemen and women from harm. Northrop is currently a Zacks rank number 2, but the possibility of an oncoming steep increase in military spending has analysts scrambling to revise those predictions. So again, while politicians in Washington often disagree on how to allocate spending on almost everything else, they universally agree on allocating resources to defense. When it becomes necessary to quickly ramp up defense capabilities, the U.S. needs to lean on companies that have the size and scale to immediately increase production and provide the necessary equipment in short order. With more than 85,000 employees, Northrop is the go-to provider of the necessary hardware and software for a sustained military effort. Owning strong defense names like Northrop is an excellent hedge against global uncertainty. They have steady revenues and earnings even during times of peace, and then steeply accelerating results during times of global conflict. They're on track to make more than $20 a share during the 2019 fiscal year and are projected to net more than $23 a share in 2020. But even after the recent run-up, they still trade at a very reasonable 16 times forward 12-month earnings multiple. It's a significant discount to the S&P at a roughly 19, and about half of the defense industry average at 33x. They also pay a steady and reliable dividend of 1.4%. So if you're like me and you think the markets are poised for further gains in the immediate future, but you're also concerned about the possibility of geopolitical risk derailing this historic appreciation, then you'd be wise to take a look at Northrop Grumman. It's an iconic American company that specializes in the defense of our interests around the globe, and it can also defend your portfolio from that uncertainty.
All right, Dave, do you own either of these two stocks?
I don't personally own Northrop or JP Morgan or in any of my Zacks portfolios, no.
Okay, and what about you, Shiraz?
I have JP Morgan and a bunch of other banks and brokers in the focus list portfolio.
Okay, thank you both for that. And don't forget, there's always more stock information, as always, on our website, Zacks.com. Also, don't forget, if you haven't checked this out yet, you are invited to follow market insights from Zacks, buys and sells and other recommendations, and even take a look at portfolios that have been up to now closed to the general public. You can do it in real time, but for a limited time only. You could do it for $1. For more details, all you need to do is visit Zacks.com/promo. With Shiraz and Dave, I'm Terry Ruffalo.